when we interviewed executives from around the world, we asked them, what is the number one thing you're doing to lean against all the external issues and existential issues to your company? And almost at the top of the list, if not at the top of the list, was innovation and digital transformation, and also looking at automation. So all of that's digital.
Welcome to This is Digital, a podcast brought to you by West Monroe. Join us as we talk to leading experts about bringing the digital mindset to your organization.
Hello, everyone, and welcome to This is Digital. I'm your host, Rissa Redden, Partner and Chief Marketing Officer at West Monroe. Thank you for listening to This is Digital. In each episode, we explore what it means to be digital, not just do digital. Today, I am honored to welcome Dana Peterson, Chief Economist at the Conference Board. With recession concerns, supply chain issues, and geopolitical tensions all top of mind for business leaders, Dana joins us to provide her perspective on the global economy and what we should expect to see for the balance of 2023. Dana, I'm excited to hear your take on the economy and what leaders should be thinking about as we navigate uncertainty.
Absolutely. Thank you so much for having me, Rissa. Well, I think the key issues right now are inflation, monetary policy, and recession. Indeed, inflation's very high around most of the world, especially the US and Europe, parts of Asia, except for China. They're not experiencing too much inflation. But certainly when we look at many economies, prices are really high and central banks are raising interest rates to combat that. But that's slowing economies down. And certainly in the US, we think we're probably going to have a recession because of the Fed's very aggressive interest rate hikes.
Thank you. As we get into the topics today, I'd love to start out with a little bit more of your background and what drew you to your field and to the role that you have today.
I fell in love with economics in my sophomore year of college in Micro 101. That's the very first economics class you take. The professor was Dr. Miller, and he was really amazing. He wore a bow tie every day. He took attendance, and he made the boys take their hats off in class. But the cool thing is that he said, there are only two things you need to know for my class on the very first day. The first thing was supply and demand. The second was what, how, and for whom. What are you making? How are you making it? And who wants it? And it turns out that was the final exam, those two questions and a bonus question. So if you paid attention on the first day, then you got everything right. But I just thought economics was just a really wonderful way to explain very complex topics in a simplistic manner.
Could you share a little bit more about the Conference Board and some of the research and activity that you help with?
Absolutely. The Conference Board is a 107-year-old business think tank focused on delivering insights for what's ahead. Our clients are members of the C-suite of Fortune 500 companies from around the world. We provide insights that include economics, ESG, human capital, marketing and communications, and public policy and geopolitics.
I'd like to get now into the topic of jobs outlook and technology. We've got a lot of ground to cover, but I'd love to start with one of the biggest topics on leaders' minds, employment. As recessionary concerns rise, we're seeing layoffs in a lot of industries, particularly in the tech sector. The Employment Trends Index published by the Conference Board states that while we're expecting more jobs in the second quarter of 2023 to offset the layoffs from the last few months, we will experience more job losses in the second half of 2023 as GDP growth turns negative. Can you talk a little bit about that? And is the outlook bleak? Are there some glimmers? I would love to get your perspective.
Well, I mean, there are definitely glimmers of hope. And I would divide the labor market up into three segments. You have the segments that are letting people go. Those are the former pandemic darlings, right? So information, technology, transportation and warehousing, retail, construction, and real estate. Those industries did very well during the pandemic when everyone was cooped up and interest rates were low. Now that interest rates have risen and also there's less demand for technology and goods, those segments are right sizing, which means they're letting people go. But then you have the other end of the spectrum where you have labor shortages, and those are mainly in those industries that are services, or you have to physically show up to work. And in those sectors, they just don't have enough workers. And so they're still hiring. And that's why we're seeing the labor market add jobs month after month after month. And some of those sectors include hotels, restaurants, healthcare, even the government sector can't hire enough people. And so we're seeing those industries increasing their payrolls. And then you have the middle, the sectors that really aren't kind of doing anything. But it's really these end points in terms of the sectors that I've talked about that are driving the labor market. And we believe as we get on in the year that the sectors that are letting people go are going to overwhelm the sectors that are actually adding. And so we do expect payrolls to start being negative probably in the third or fourth quarter and the unemployment rate to rise. But we think the unemployment rate's probably not going to rise by that much, maybe 1 percentage point. So going from roughly 3.5% right now to 4.5%, that's still a really tight labor market. Indeed, it's so unlike past recessions that we've seen. Certainly during the pandemic, the unemployment rate shot up to 13.5%. And during the Great Recession, it rose to 10%. We're not going to see anything like that. But certainly for the people who get let go, it's no laughing matter.
Absolutely. You mentioned the tech sector. I'd love to shift a little bit to tech developments. Generative AI is having a moment, ChatGPT, of course, being one of the generative AIs. From your perspective, how will AI impact the workforce?
Well, it's going to be both destructive and creative. It's going to be additive and it's going to subtract some things. So where it's going to be beneficial is time saving. So just think about someone like an economist. We spend a lot of time doing research and writing reports. Well, it might be helpful to just kind of get a paper started, to put in a few code words to kind of get a sense of what AI would tell us. Now, you still need the human component, right? Because AI, generative AI, is just using existing content, pulling it all together in a very smart way. So you needed human beings to come up with the intellectual property in the first place. And so it definitely is going to save time, but you still need the human element. Now, that's where it's additive and also supportive. But it is going to put some people out of work. Certainly, when we think about writers or even newspapers that rely on content. Now, if you can get generative AI to pick all the right information from a bunch of areas and then put it together, then you're going to see some people who are out of work. But that's every technological advancement. There's always creation and there's always destruction.
I saw a LinkedIn post just this morning, and it was somebody posting about summer activities for children and using generative AI to create a summer schedule. And it makes me wonder then, I think you're exactly right. It's the highest and best use of people's time, and it frees people up to be focused on the highest and best use of their time. But it's interesting to think about the personal and the professional, that there's been a lot of discussion of the professional, but the personal is certainly a piece of the puzzle as well. Okay, in your article discussing U.S. CEOs and their preparation for a brief and shallow recession, you shared that of the CEOs surveyed, 93% are preparing for recession. What are you seeing CEOs do to prepare?
Many of them are thinking about what to do with their labor forces, what to do with their sales. And the interesting thing is that many of them are still looking to hire, or they're going to hoard workers, meaning they're just not going to let anybody go. They're going to hold on to them. And the hoarding has to do with two factors. Number one, they're saying we think it's not going to be that bad and it's going to be short. So why would we let a bunch of people go only to have to turn around and bring them back, maybe at a higher cost? And then the other issue is, again, labor shortages. And even though labor shortages might lighten up a little bit over the next few quarters, they are a long-term problem. And the reason why is all the baby boomers are retiring. They're leaving the labor market, and there aren't enough younger people to replace them. And also, many baby boomers have quite a bit of experience. And the younger folks aren't quite there yet because they haven't lived long enough to get experience. So that's a big challenge for many businesses. Some businesses, like I said, are letting people go, but a lot of that's right sizing from extreme hiring during the pandemic. But for many businesses, they're just looking to kind of sit tight and hold on to their labor. Other businesses are still being challenged by very elevated input costs. And those input costs come from certainly still lingering supply chain issues, especially in technology, but also input costs from just higher wages, where they had to spend a lot of time and a lot of effort and a lot of money to attract talent over the last year or so. And once you raise wages, they're just kind of there forever. And so businesses are trying to figure out how to make that work. Another thing businesses are actively doing is increasing their liquidity. So making sure they have cash on hand. And a lot of that has to do with the banking crisis. But even before the banking crisis, they were looking at liquidity issues, especially since the Fed's raising interest rates and certainly making it much more expensive to go to financial institutions for cash. And certainly capital markets aren't always easy. And especially when you're looking at something which might be a downturn, it might be difficult to gain access to liquidity from there as well.
We've been talking about recession concerns since last summer/fall. Is the recession here?
When you look at a number of measures that we have, so we have, well, I guess three measures. One is the CEO confidence survey you just mentioned, where CEOs last year around this time were saying, yes, we expect a recession at some point over the next year, right? So it's a year later. And then we also have our consumer confidence gauge, where consumers have been expecting a recession sometime over the next 6 to 12 months for the last 12 out of 13 months. So here we are, right? This is roughly about there. And then we also have our leading economic indicators gauge, and that's been pointing to a recession starting right about now. But again, the big thing is, well, how do you define a recession? Usually you would have massive layoffs. But again, we think there's not going to be much worsening in the labor market because of labor shortages and because you have so many people exiting. And so companies have to continue to hire or hold on to workers. So all of our gauges are saying that the recession should be starting right about now. And really the key is the consumer. If consumers feel like something is going on, if something is bad, if they might lose their jobs, then they're going to pull back on consumption. And we have seen some pulling back in consumption in two areas. Number one, consumers have stopped buying houses. Why? Because mortgage rates are through the roof, because the Fed raised interest rates by 5 percentage points over the last year. So that's cooling off. And when people don't buy homes, they don't buy all the great things that go along with a home, like refrigerators and cars and lawn equipment and that sort of thing. So that's one area. A second area is consumers have pulled back on buying big ticket items that you need to finance, like furniture and cars. And so the last piece of the puzzle, really, for there to actually be a recession where the consumer is driving it, is consumers pulling back on services. And certainly in the last few readings of retail sales and also personal consumption expenditure data, we've seen consumers spending a little bit less on services. And when we asked them in our consumer confidence index, what are you going to be doing about services? Consumers said, yes, we are going to be pulling back on services, especially highly discretionary services and things that we don't really need. And we are going to spend on things that we do need. As that's happening, we think that that's really going to signal recession. And let's not forget businesses. Businesses have already pulled back on investments in a lot of areas, and they're probably going to continue to do so, not only in terms of human capital, but also in terms of equipment and structures. And the last piece to fall is IP.
You mentioned the Federal Reserve, Dana, and that we've seen 8 interest rate hikes from the Federal Reserve since March of 2022. Last week, Austin Goolsbee, who's the new president and CEO of the Chicago Federal Reserve, spoke at an Economic Club of Chicago event. And he talked about recessionary fears as being a bit like we have an anvil that is floating above us, and we're not sure if it's paper mache or if it's iron. What's your perspective on that? Is it paper mache or is it iron?
Well, a paper mache, I would imagine if that falls on your head, it doesn't really have any effect. And so maybe it's not really a recession. But if it's an anvil, that's going to hurt. And we think that this recession probably will hurt a little bit. That, and certainly in terms of weakening in the labor market and consumers pulling back on consumption. But it's not going to be anything like we've seen in the past 2 recessions. So when we think about the pandemic, that was induced by shutdowns. We told everybody to go home, don't go out. And so the economy collapsed overnight. It was really severe. And it took about a couple of years to come back from that. And then, so that's not usual. That was very unusual. And then we look back at the last recession was the Great Recession, and that was caused by a financial crisis. And that's special and very severe because usually it takes 10 years to fully recover from that. We think this recession is going to be a little bit more like a regular recession. It's being induced by high inflation and the Fed responding to that by raising interest rates. We've had many recessions like that, and they're not as deep or as bad, except back in the 1980s. But inflation was really out of control, and the Fed had to be very, very aggressive. And we're seeing that aggressiveness now. And so, again, this is going to be a real recession. We think it's not paper mache. But what's going to make it not as bad is the dynamics of the labor market. We've never had labor shortages like this ever. Usually when we had labor shortages, there was a quick fix, right? Back in the 1800s, you had immigration. During the world wars, you had women come into the labor market. During the 70s, women came back to the labor market after being pushed out. Now, you don't have a quick solution, right, in terms of immigration or bringing women into the labor market because so many of our elders are just leaving the labor market because they're retiring. This is a structural shift. And because of that structural shift, the behavior of our labor market indicators that we like to look at is just going to be very different. And so even though you could potentially lose about 1 million jobs, you'll still have, roughly 96% of the population still working.
Austin Goolsbee also described the role of the Federal Reserve as to be more paranoid than anyone. That's what they pay us for. And I'm curious to get your perspective. Is that an accurate assessment of the Fed, or should it be?
I guess paranoia in a good sense, right? Because it is the Fed's job to help manage the economy through financial channels. And the Fed is also responsible for financial stability. Financial stability is kind of like their third mandate, right? It's not official, but that's what they do. And they're also highly concerned about making sure that inflation is right in balance, and also the labor market. And so between inflation, the labor market, and financial stability, that's a lot of work. And so the Fed must be vigilant. And if the word is paranoia, okay, but I think a better term or another term is vigilance. And that's the way the Fed should be to make sure that the economy is humming along well.
So next, I want to shift a little bit to Silicon Valley Bank. Most recently, and probably one of the biggest stories in a while, we saw the failure of Silicon Valley Bank and Signature Bank. You authored an article titled The Silicon Valley Bank Collapse and Implications for Business. Could you dive into your findings and insights into how the downfall of SVB has affected businesses, both from an overall point of view as well as from a banking and financial sector point of view?
Sure. There are many reasons for why those two banks failed and other banks got into trouble. We can talk about that in a second. But what does it mean for businesses and consumers? Well, it means tighter financial conditions. What do I mean by that? Well, many banks especially smaller ones, are having to go to the Fed to borrow through their primary credit facility. And so they're borrowing money from the Fed to remain liquid. So if you think about yourself, if you're borrowing money from your parents to stay liquid, and one of your best friends comes to you and asks for a loan, you're probably not going to give your friend that loan because you're borrowing from mom and dad to have cash. And so it's the same thing with banks. Because they're borrowing from the Fed, they're less likely to issue credit or lending cash to businesses and consumers. Now, I think this is probably going to affect businesses a little bit more than consumers. Here's why. Consumers have already been pulling back, right? Because interest rates have risen, 5 percentage points. So the Fed funds rate target has risen 5 percentage points. And that's affected mortgage rates and the cost of borrowing and financing. So consumers have already kind of pulled back. And when we think about what consumers are buying a lot now, it's services. And a lot of services that you don't necessarily finance. And the only financing you might do is put it on your credit card. And there's been no issue with credit card borrowing, right? But when it comes to businesses are going to go to these banks and ask for capital, or rather cash, for short-term purposes, for operating costs, but also for big investments. And if the bank is saying, well, I'm borrowing from the Fed, I don't really want to give to you. So that means businesses are going to have to pull back on their plans for long-term investments. And they may also have difficulty getting cash for those short-term needs. And then also if they go to capital markets, well, financial markets are Almost, well, except for banking, but in terms of the bond market and the stock market, they're both doing okay at this point. We got over the banking crisis, the worst of it. There may be some other shoes to drop, but there's a framework to ring fence the problem and keep everything pretty well contained. But still, in all, financial markets may not be that generous. So that's why I think businesses, especially smaller ones that tend to go to these small and medium sized banks for loans, are going to be challenged in terms of getting that cash to conduct investments and also their daily operations. So that's the tightening in financial conditions that we expect.
And I'm curious, what you think about the spillover effects. That what will this mean for small business, and what will it mean for the tech sector, or what will it mean for private equity? Because it is a very, I think, interconnected. It's not simply a story about banking. Do you agree?
Yes. So for small businesses, many of them usually go to these small regional banks to borrow. And when you look at the deposits for small banks have been collapsing. Well, they collapse and they're still falling day to day. And so that means people pulling their money out. They're going to the bigger banks. They're also putting their money in other assets like money market funds and high yield savings accounts, et cetera. But, even if they're not pulling their money out, again, these small banks are borrowing from the Fed, so it's very unlikely that those small businesses will get cash. When it comes to the tech sector and venture capitalism, yes, this is a huge blow because Silicon Valley Bank and other institutions that modeled their business practices similar to them had access to very exotic and bespoke types of capital and lending. And now that's kind of wiped out, right? So now businesses and tech firms are going to have to go to angel investors, or they're going to have to go to the larger banks. And the larger banks are more likely to offer more vanilla types of products and also will be less likely to lend to startups where it's not really clear that there's any valuation in this service. And so I think it's going to pose a setback, certainly for this sector, for startups and for the technology industry.
Next, I'd like to move to the third leg of our stool, if you will, which is geopolitical tension. When you look across the world today, what are some of the things that you see?
Sure. There are essentially the world is kind of dividing into nodes, right? So one node is the US and its allies. So you could fold in Europe and Japan and South Korea and Australia. And then you have China and its allies, and you can fold in Russia, potentially like India and parts of the Middle East. And then you have everybody else, right? And everybody else is trying to figure out who they're going to be friends with. And some of those economies are being neutral. And some of them are, kind of burning the candle at both ends, like trying to be friends with the US and its allies and China and its allies. And so you have this multipolar world where there is skepticism about traditional institutions and multilateralism, right? And there's been this shift towards more protectionism, right? And if you think about it, between the US and China, we depend on each other for trade. If you take a look at the clothes you're wearing and you take a look at the tag, most likely it's going to say made in China. And a lot of the goods we use in the US come directly from China. So we like to buy things from China, and China likes to sell us things. So we're very much dependent. But the two economies are engaged in kind of a de facto Cold War. And that's along a number of fronts and along technology, where there's this race, if you will, a space race, both also literally, China's in space and so is the US, but this race between 5G and AI and who's going to come out with that technology and who's going to adopt it, right? Other economies. Also with respect to trade, when we had the trade wars during 2018 and 2019, those tariffs and limitations were never lifted. They're still in place. And certainly there's a war over influence, soft power, right, where China has its Belt and Road Initiative. And essentially that's meant to follow these quote unquote trade routes, but instead of, mainly trade, it's about influence and power. And China's lending to other emerging markets and developing economies and creating these relationships. And meanwhile, the US is also trying to do the same thing. And then you also have hard power, which is military power, where the US is challenging China in terms of China's views on Taiwan and the South China Sea. And, essentially China wants to be the local hegemon in Asia, and the US doesn't want that to happen. And so you have this Cold War that's happening, and all the other economies are essentially having to choose sides. And so that's, the multipolar issue. And then, of course, there's a war in Ukraine, which is still going on. And even though here in the United States, Ukraine is really far away, it's really about Russia versus NATO, right? And Ukraine's not in NATO, but Ukraine does want to be a part of NATO, and the US and NATO allies see this as Russia invading Ukraine. That encroachment is just the first, of many attempts of Russia to kind of create this barrier between itself and the West with economies that were formerly part of greater Russia, right? So a lot of it's historical, but these economies are all independent and they don't want to be taken over. And so you have that big geopolitical issue. But the thing is that Russia and China are also best friends. So that brings in China back to that multipolar world where you basically have the US and its allies, China and its allies, and everybody else trying to figure out where they belong in this new world.
I'd love to hear your perspective on what this means for supply chains. We had some discussion on a previous podcast about companies that are building in more redundancy, that they're essentially creating two supply chains where there may have been one previously in order to guard against something happening in a given location such that they wouldn't go down or go dark. Is that something that you're seeing, or what are some of the other implications from a supply chain standpoint?
Sure. What's being born out of increased protectionism and the shock of the pandemic, where supply chains were just wholly disrupted because of the disease itself and all the shutdowns and lockdowns, governments are instituting something called industrial policies, where essentially they tell businesses where they can situate their supply chains and also their factories. Right. And so if you're a business, you have pressures all around. You have pressures of, well, what if another pandemic happens? Or what if there's some war or something that disrupts my supply chains? And oh, by the way, the governments and the economies I operate in are telling me that I need to create redundancies or I need to reshore. So businesses are stuck in the middle. And indeed, we asked in a survey back in November, things might have changed since then, but we asked businesses across the world, many different regions, what are you doing about your supply chains? And then the US, the most common answer, 44% said nothing. We're not doing anything for our supply chain. The other answers were, yes, we're reshoring or we're creating redundancies or we're nearshoring, which means we're going into a region and building out the supply chain there so it's self-sufficient. We don't need international trade to manage that. Or we are quote unquote friendshoring, which is really diversification, right? You're moving your supply chains and your factories around, but in economies that your government is friendly with. We're seeing all those things happen, but still in all, you have a big chunk of businesses that aren't doing anything because of a variety of reasons. Either one, they're in markets like China, which is a huge market. I mean, there are 1.1 billion consumers there, right? So why wouldn't you operate in China? There's a reason why supply chains and factories are so far-flung, because it costs less. And so businesses are having to make these decisions, and they're challenged by this. So some of them are trying to get out ahead of the problem. Others are waiting for a crisis or governments to twist their arms and say, you must do this. And others are just hoping that there's going to be some kind of peaceful resolution and that these things work out through free markets. But all in all, businesses are definitely being squeezed by the geopolitics, the shock of the pandemic, and the realities of issues around trade.
And as you think about supply chain, are you seeing more of a shift toward digital as a way to mitigate some of this uncertainty, as a way to create greater confidence perhaps in the systems that are in place?
In that same survey that when we interviewed executives from around the world, we asked them, what is the number one thing you're doing to lean against all the external issues and existential issues to your company? And almost at the top of the list, if not at the top of the list, was innovation and digital transformation, and also looking at automation. So all of that's digital, right? So companies are trying to figure out how to become more efficient using technology, right? So whether it's making sure their supply chains are running properly, and that, you have just in time and that all of your products are where they need to be and your factories are humming along. All that is digital. And companies are looking at that as a way to not only supplement workers, but also to advance themselves and make themselves more productive. And also, a lot of companies are using technology because they can't find workers. Again, the labor shortages. And labor shortages are an issue not only in the United States, but also in Europe and China and Japan and a number of other very large but aging economies, aging meaning their populations are aging. And so companies are using automation. So if you think about it, if you go to your local supermarket, there are more self-checkout lanes than there are checkout lanes with people. If you go to a restaurant, you're handed a QR code and you have to break out your cell phone, right? So there are a lot of ways that businesses are using technology to not only become more efficient and productive, but to actually supplement labor.
Well, I find it fascinating that constraints often lead to creativity. That because
Absolutely.
of a shortage of some sort, you have to look at alternatives. And something that I find really fascinating about digital in particular is that it's on both sides of the equation. That from an innovation, from a revenue perspective, there is opportunity, but then also from a cost reduction or cost containment standpoint, there's also opportunity.
Absolutely.
So I think digital is the answer.
Yes.
And speaking of which, Dana, so a question that we love to ask all of our guests is, what does digital mean to you?
Well, digital is anything that requires technology, right? So semiconductor chips and STEM research and anything that you need more than just human capacity, but you need that aid of technology to make things great and more efficient and more productive. But you can't lose the human element, right? You need human beings to come up with the intellectual property. You need human beings to maintain it. You need human beings to innovate and also to make sure that the technology doesn't get away from you and run away and become sentient. Kidding. But certainly that's a big issue with generative AI. But even with that, you still need the human element. So I see it as technology and humans working together to make and do great things.
I love that. You remind me of Life 3.0. I don't know if you've read that from Max Tegmark out of MIT, and it's different scenarios for an AI future. And that is, the references to HAL and 2001: A Space Odyssey. I mean, it's fascinating to see what the future could look like, and there are pros and cons to various scenarios. So I love that. As we conclude, Dana, are there any important takeaways or any final thoughts that you'd like to leave our listeners with?
Sure. Well, I did bring some doom and gloom with recession, labor shortages, all these awful things. We think that it's probably going to be short-lived. And by the time we get to next year, inflation's going to be a lot lower because of the work that the Fed is doing, probably getting back to the 2% target, which is optimal by the end of next year. But even before we get to the end of next year, by the end of this year, inflation's probably going to be around 3% instead of 5%, right? So that's going to be good news. Also, like I said, the recession's probably going to be short and shallow. So that means, again, not too many layoffs, and that most people will still be working, and then we'll be out of it next year and we'll see somewhat faster growth. Also, when it comes to geopolitics, there's certainly definitely upside risks. Upsides in terms of things that can go well. Maybe the war in Ukraine will end peacefully, or China and the US will end their trade war, or there'll be other developments that will be constructive. But I'm certainly very optimistic in terms of productivity, and certainly technology is a huge part of developing and supporting productivity. And technology means adopting existing types of technology, right? Like quantum computing. Well, that's very new, but it's going to become something that's really awesome. 3D printing. Imagine if everybody had a 3D printer, right? You can just make things at home potentially. All these things will be positive, but also the green transition. Technology is going to be such an important aspect of that. And certainly when we think about infrastructure, building out infrastructure to allow the green economy, to enable smart cities where people can be more productive and efficient. So I just see tons of opportunity out there, not just all the bad stuff that I already talked about.
Well, thank you so much, Dana. It's been a real pleasure to chat with you and to hear your perspective on the world and where we're headed. Thank you.
Absolutely. Thank you.
Thanks for listening to This is Digital. If If you enjoyed today's show, please follow or subscribe on your preferred podcast app. And don't forget to leave us a review. For more information on This is Digital, visit westmonroe.com/thisisdigital.